Most people with IRS debt have heard of one program, the Streamlined Installment Agreement. It set you up on a payment plan if you owed under $50,000. You got 72 months to pay. It was the workhorse of tax resolution for over a decade. In 2026, the IRS quietly replaced it. The new plan is called the Simple Payment Plan. It looks almost identical on the surface. Same balance ceiling, same easy approval, but it does one big thing the old plan never did. It gives you 4 more years to pay. That is a quiet change with loud results. Here is what changed and why it matters. The old streamlined plan capped your payback at 72 months. So if you owed $48,000, the IRS divided it into a monthly payment of around $660 before interest. For a single parent, a small business owner, a trucker between loads, that number was the difference between paying the IRS and feeding the family. The new simple payment plan caps your payback at 120 months. The same $48,000 debt now slides into a payment closer to $400 a month. Same debt, same income, a new line on the budget you live with. If you have an existing streamlined plan from 2024 or 2025, you might be paying more than you need to. The IRS does not pull you into the new plan automatically. You have to ask. Most people will never know they have the option. Here is the second thing they changed. Allowable living expenses got an inflation update in 2026. These are the numbers the IRS uses when it decides what is a reasonable amount of money for you to live on. Food, housing, transportation, healthcare. The bigger your allowable expenses, the smaller your disposable income, and the smaller the IRS expects your monthly payment to be. Most of these caps went up. Some of them went up a lot. Housing in high-cost cities moved meaningfully. Healthcare moved. The IRS does not advertise this. It rolls them out in a sleepy spring announcement, and that is it. The combination of a longer plan and higher expense caps means more taxpayers qualify for a lower monthly payment than they did under the old rules. Some of them qualify for a payment so low, the math switches them into currently not collectible status, where collection stops entirely. There is one more piece, and it matters if you are over 65. The senior deduction added $6,000 to your standard deduction in 2026. The IRS uses your disposable income when it builds your payment number. A bigger standard deduction shrinks the income side of the equation. For older taxpayers with a fixed Social Security check, the senior deduction is a quiet tool to make a settlement or a small monthly payment qualify. So what should you do if you owe the IRS in 2026?
If you owe under $25,000, the new plan is almost automatic. You apply, set up direct debit, and you are done. No financial disclosure, no long phone call, no agent reviewing your spending. You pick a payment number you live with, send it in, and the IRS accepts it. If you owe between $25,000 and $50,000, you still get the simple track. The IRS will ask for direct debit. No long financial form. You get the longer payback window. If you owe more than $50,000, the simple track ends. You enter the world of full collection financial disclosure, Form 433A or 433F. The IRS reviews every dollar of your income, expenses, and assets. This is where the new allowable expense numbers pay off, because they are also used for taxpayers above the simple plan threshold. If you already have an old streamlined plan running, ask your tax pro to review it. There is no penalty for switching to the new structure. There is also no automatic switch. You either ask or you keep paying the old number. There is a trap to watch for. The simple payment plan is easy to set up. It is also easy to default. One missed payment, one new tax year filed late, one new balance owed, and the whole plan blows up. The IRS sends a notice. You have a short window to cure the default. Miss it, and the agreement is gone. So is your protection from collection. Set up the direct debit. Set a calendar reminder for tax filing dates. Get your withholdings or estimated taxes right so you do not owe again next year. The plan only works as long as you do. A few people have asked me if the simple plan is the same as the Fresh Start program. It is not. Fresh Start is the umbrella that covers payment plans, offers and compromise, penalty relief, and lien relief. The simple payment plan is one tool inside that umbrella. The new tool is easier and longer than the old tool. Here is your action plan if you owe the IRS right now in 2026.
Pull your account transcript at irs.gov to see your real balance and your assessment dates. Add up what you owe across every year. If the total is under $50,000, apply for the simple payment plan online and pick a payment you will not miss. If the total is over $50,000, call a tax resolution professional before you fill out anything. The numbers you put on the financial form decide your monthly payment for years. The IRS changes its rules in quiet ways. The people who win are the ones who notice.